Hello and welcome back to the Dukascopy TV studio. Up next is one of our more outspoken guests. Joining me now to discuss the link between deflation and unemployment is Dr. Frank Hollenbeck. Frank, thank you very much for coming in.
Good to be here.
Okay, now to get started, the ECB unexpectedly cut its main refinancing rate to a record low 0.25%. And this was in an effort to avoid the dreaded deflation prices in the Euro region. We've had several recent articles which have praised this move to avoid a Japan-style deflation spiral in the economy. Now, Dr. Frank, you did an interview with us previously discussing deflation, which has since spurred you on to write this article. Now, what do you have to say about a lot of the discussion being dished out regarding deflation at present?
Well, it's really an unjustified fear of deflation. There really is no good theoretical reason why we should be afraid of deflation. There was a study done by Atkinson and Keogh that looked at 17 countries over 180-year periods, and they found no relationship between deflation and depression. So they actually found a greater number of episodes of inflation with depression than deflation with depression. For example, out of 73 deflation episodes, they found that 65 of them did not have a depression. And out of 29 depression episodes, they found that 21 of them did not have deflation. So there really is no link between deflation and depression. Now, I don't necessarily agree with the European Central Bank's strategy. First, the European Central Bank should not be interfering with what is essentially a relative price change. In other words, the euro appreciated, which caused input prices to drop, and that's why inflation dropped in the euro region. The central bank should not be interfering with relative price changes. And also we have to ask, is 2% a ceiling or is it a target? Okay. If it's a target, it basically means that the central bank would be continuously printing. Okay. Now, 2% may not seem like a lot, but over 50 years, it's a massive transfer of wealth, okay, from the late receivers of the money, which are the wage earners and the poor, to the early receivers of the money, which are the governments and the banking sector. So it's a transfer from the 99% to the 1%.
Now, Janet Yellen, in her confirmation testimony, stated that the Fed would continue its QE program until the economy improved and unemployment declined. What do you have to say on this?
Well, as a professional economist, it's getting harder and harder to understand the current strategy behind U.S. monetary policy. We know that monetary policy has basically two channels in which it can affect the real economy. The first one is to reduce interest rates so that it ends up spurring consumption and investment spending. The second channel is to increase inflation so that individuals' real wages drop, okay, which leads to additional employment and output. This is known as the Phillips curve trade-off. Now, when we look at the first channel, okay, we've basically reduced interest rates to almost zero since 2009, and we have very little to show for it, okay. The central bank can bring a trough, a lake, an ocean to a horse, but it cannot make it drink. Okay, a lot of this excess liquidity that's been put into the system has just ended up as excess reserves. Okay, in the sense that the banks have very few credit-worthy customers who want to borrow. We know that the household sector is still deleveraging, and we know that businesses are wary of making any future investments when they know that the malinvestments of the last bubble hasn't been cleared off, and that the central bank policy is creating an enormous amount of price distortions in the economy. Now, since the first channel hasn't worked, we're only left with the second channel. However, I would say almost all economists agree that there's no long-run trade-off between inflation and unemployment. It is true that the Keynesians and the monetarists believe that there may be a short-run trade-off. In other words, if individuals have adaptive expectations, in the sense that they only look at the past to make future decisions, okay, then the printing of money, which leads to inflation, will lead to a drop drop in their real incomes and therefore lead to an increase in employment. However, once people realize that they've been fooled and ask for an increase in nominal wages to bring their real income back up to the previous levels, then there is basically no long-run trade-off between inflation and unemployment. Okay. If instead people have what we call rational expectations so that they're not fooled, this is the neoclassical position, okay, then there's neither a short-run or long-run trade-off between inflation and unemployment. In reality, there's actually a positive relationship between inflation and unemployment. And the reason is because inflation creates what we call an information extraction problem. Okay? When prices are going up, it's very difficult for an entrepreneur to determine whether the increase in price is because there's greater demand for his product, or is it because all other prices are going up. In the sense that, are prices going up because people want more of his good, or is it just because we're changing the measuring stick, which is the money supply? If economists agree that there's no trade-off between inflation and unemployment, and that the strategy to cut interest rates has not spurred either consumption or investment spending, then we must ask, why is the central bank printing $85 billion a month? Okay, is the purpose to sink the middle class further into poverty? It's a very, very dangerous strategy. Okay. Also, if the Fed is essentially printing money to cause asset prices to go up and hoping that we have some type of wealth effect, then we may actually have a popping of the bubble before we see any type of wealth effect. Okay, the central bank should not be playing the economy as some type of poker game. We can be certain that interest rates will shoot up once inflation picks up, okay? And since most of the U.S. debt is short-term, it's going to have a very hard time to inflate the real value of its debt, okay? How will the government react when interest rates are at 20%, like they were in 1981? Okay. Will the central bank be able to take the necessary actions to calm inflation? Okay. The next chairperson is basically no Volcker. Okay. Also, will it be allowed to tame the beast of inflation? We know that Germany in 1921 and 1923 had an independent central bank, but that didn't stop the government from printing money to get out of the problem. So my question is that why are we taking these type of risks?
Frank, always an enlightening experience having you in the studio. Thank you very much. That's all for now, but we'll be back shortly with more exclusive interviews for you. So see you then. Goodbye for now.